Hello and good morning, or I should say good afternoon, everyone. It seems like we have a unusually large contingent from Australia today, so you guys are a couple hours ahead of the rest of us, and so you're already into the afternoon. I'd like to thank everyone for joining us today for our Process Alpha Sherpa Funds Technology webinar, The Risk Your Investors Want, focusing on long-short equity strategies. My name is Stephen Quimby. I'm joined by our founder and CEO, Richard Waddington. Richard, can you say hello to the folks?
Yeah, hi, good afternoon, everybody. Great to be here again, and great to be here with Stephen in the same time zone for the first time for a long time, I think. So,
yes, I've moved from an office in the States, a home office in the States, to a home office in rural Korea. So slowly moving my way back across the globe in the midst of the COVID situation. So I'd like to thank everybody for taking the time to join us today. For those of you who are new to our Sherpa Process Alpha webinars, generally speaking, we try to cover our topics in plus or minus half an hour. We might run a little bit longer. We might run a little bit shorter. And during that time, you're welcome to ask questions in the webinar chat at any time. If you have questions that you think are particularly pressing, slot them in there. Otherwise, we will be doing Q&A at the end. So feel free to hold on to your questions, and we'll definitely take as much time as anybody wants once we get to the end of the main presentation to make sure that we answer any questions. So the topic that we're talking about today, our most recent webinars really have focused on the actual process of portfolio construction. So it's focused on topics around candidate portfolios, candidates around the risk quality graph, things around the actual process. Today, what we're really going to talk about is defining one of the inputs. And at Sherpa Funds Technology, we frequently use the phrase more of the risk you want, less of the risk you don't. And so what we're going to be talking about today is the risk that you want in your portfolio, and specifically the risk that you've talked to your investors about what they want and what you've sold on to your investors. So briefly speaking, we're going to talk about different types of long-short equity strategies, which types of risk are sort of embedded in those, which risk levers are going to be those that you modify to achieve your different objectives in these different strategies. We're going to construct a series of portfolios using the same stock selection alpha, but to generate portfolios that are compliant with the different risk objectives for the different equity strategies. We're going to show how, practically speaking, those portfolios, they have the same stock selection, so it's the same alpha input, the same research, the same process, but it delivers very different risk and a very different experience or set of outcomes to the investors. And so these portfolios are all valid depending on what you've sold your investors. So that's to say, what risk do your investors want? Then we'll talk a little bit about the impacts of residual risk and what that means in terms of how you can refine the process to make sure that what you're actually delivering is sort of comprehensively thought through so that you don't have residual risks that are unexpected or unanticipated impacting your performance. And then finally, we'll also talk about the degree to which, once all of that's set up, all the things that your investors want from you, all the things that you've got your risk team, your boss looking for, how the individual PM, you as the PM, can sort of fine tune the level of risk within those parameters to make sure that you're really building a portfolio that you're comfortable with. Okay, so broadly speaking, the reason we've chosen long short equity to talk about today, these same ideas really are applicable across strategies, but long short equity remains a popular strategy, but it's a popular strategy that's had a bit of a rough go the last few years. And practically speaking, one of the things that you see in the long short equity space is that managers need to consistently deliver on what they say they're going to deliver. And practically speaking, that means they need to consistently deliver stock selection alpha. So if you don't have alpha, practically speaking, your investors are probably going to be looking elsewhere. But further, you need to deliver that alpha in a product, an investable portfolio that takes the risks that you set out to your investors that you're going to take. And so if you're delivering alpha, generating alpha, and delivering it with the risk characteristics that your investors want, this is still a thriving space. If you're not, If you don't have the alpha, or if you're not consistent with the risk you're delivering, then this is a space where maybe it needs some challenges. So practically speaking, we're going to walk through how we can modify some of these different risk objectives to deliver different types of equity long-short portfolios. So all of them are fundamentally about delivering this selection alpha. But the different strategies vary in terms of the type of risk and the amount of risk they deliver. And so when we talk about long-short equity, obviously you're going, long stocks that you think have good prospects, short stocks that you think maybe don't. How much risk is left over, or what risk you're exposed to, really is what these strategies define. So a few strategies we're going to talk through today. We'll talk through a 1XO. So in this case, we're going to use sort of the traditional 130-30. We're going to talk about a long biased or sort of a long hedged strategy, and we'll talk about a few market neutral strategies. Now, obviously, each of these has very different exposure to the market, so very much a fundamentally different risk proposition. So when we think about this, there's a lot of different levers and ways we can think about risk, both in terms of a portfolio construction perspective and an after the fact risk attribution perspective. But let's just think about all those different levers, all of those different risk metrics as a continuum. So as a spectrum of possible risk. And in this case, we'll take net exposure as an example. All of these strategies have more or less net market exposure. And so when we think about these different strategies, something like a 130-30 retains essentially, plus or minus full 100% market exposure. And that's going to vary through time. It's going to vary as the different stocks move, depending on how closely you've rebalanced, whether or not you're taking a different view. A long biased strategy could target 50% or 40% or 60%. So it's going to have a market exposure that, isn't full like a 130-30, but isn't on the other end of the spectrum as a market neutral. And so basically each one of these types of strategies is setting a range or a box in which we can play in terms of this net exposure value. So it's giving us this movement around the spectrum. If you're long biased, you don't want to be 100% long. If you're market neutral, you don't want to be 40% long. So if we think about some of these different levers, some of these different metrics that are going to define what these strategies look like, if we think about raw market exposure, so net exposure and gross exposure, those are very obvious and relatively straightforward to think about. If we think about factor exposures, so are we taking active factor bets, active factor tilts? Is there a value tilt to the portfolio? Is there a momentum tilt? Is there a quality tilt? Or on the other hand, are we looking to isolate stock-specific risk? So really just the idiosyncratic alpha of those specific names that you've chosen to include in the portfolio. And then finally, we can also think about the spectrum of absolute amounts of risk. So whether you have a volatility target or a drawdown threshold, the old famous millennium drawdown threshold of 5% and there's a tap on your shoulder, right? That's still a spectrum. You could take 4%, you could take 5%. Maybe you could take 5 1/4 and get lucky and hope that you slide in under the wire. But so all of these are the different spectrums that we're moving on with these strategies. So when we're thinking about the different considerations, we want to think first, which risk does our investor want? So what type of risk do they care about? Next, we want to think about how much of that risk do they want. So if we think back to our net exposure chart, we're thinking about exposure to the market. That's the type of risk. And then that box or the strategy, the mandate we have is how, broadly speaking, how much of that risk do they want? And then you as a PM need to choose within that box, where do you want to try to be? Do you want to be, if you can range anywhere in a long bias strategy from 40% to 60%, do you want to be at 50%? Do you want to be at 45? Do you want to be at 40? And so if we were to visualize this, very simply with our net exposure example and our long bias. So again, the long bias here is bracketing a box in the spectrum of potential net exposure that we've agreed we can have. And then as a PM, you're choosing where in that box exactly do you want to be. So if you're saying that 50% is sort of your average or your target, at this point in time, at this point in terms of composition, do I want to be 60% long? Do I want to be 40% long? And so this really helps as a framework to think about the levers of what risk your product is supposed to be delivering and what's going to be defined by your investors, defined by your risk team, defined by your CIO, versus what as a PM you should be more concerned about in terms of how much risk you're individually comfortable with. And so we're going to walk through this with a number of these different strategies and actually show how we can transform that alpha into these different shapes and deliver the risk that really you and your investors want. So Richard, walk us through this.
Yeah, thanks, Stephen. So that kind of is a very good overview of what we're talking about. And let's now go into a specific example, well, a set of specific examples, all based on the same alpha signal. So we happen to be working with some providers of AI signals, and we have a long history of alpha signals going back and portfolios based on them. So this particular one, based on primarily it's the 700 most liquid in the Russell, so highly liquid, no issues about trading, very simple stuff, and it's an active long short. What does the signal actually look like? Well, we've taken whatever this is, 18 months, and for any given stock at any month, and for the purpose of this exercise, we do monthly. Actually, the live portfolios trade bi-weekly, but for any stock has got a score given any month, and the score can range from roughly plus 90 to minus 90, depending on the drivers of the signal. And really, we're not here to talk about that today. That's something we can go into later. So if you actually look, the actual signal looks more like this, and you can imagine keep going across the right. There are 700 stocks, and the signal changes every month. And the point is, you have to create a portfolio from this. So we take the Sherpa process and we create a bunch of different portfolios from this to illustrate the different outcomes and the decisions that have to be made when creating a product that matches what a client is after, right? Because the game here is creating investable product. It isn't so much about being right, it's about being investable. And the two things are not exactly the same. So let's just walk through what happens with that same signal, so that same block of data as the input. And we're going to walk through it. And this is all done, out of sample, actual historical, real data, not back testing stuff. And create 4 different portfolios. So a 130-30, so clearly that retains market risk. A long bias, which is a 150-100, so about 50% market risk. A cash neutral portfolio, and then a factor neutral. So if you talk about risk neutral portfolios, you can say I'm neutral in cash, I'm neutral in beta, market beta, and then I'm neutral in whatever factors you care about. And clearly, if you're in the business of selling through consultants to large US endowments, you need to generate very high specific risk, very low factor risk. So your neutrality has to be across many dimensions. And I'm sure you guys I see our attendees are all experienced long short guys, so you'll know what I'm talking about here. So just quickly going through what these portfolios, and the big block of data, let's not worry about this for a while, we'll come back to this in a second, but we got a 130-30, so roughly 50 stocks long, 20 stocks short, 130-30, so net of 100, gross of 160. We got we're a long bias, so again, 50 long, a few more shorts, 150 versus 100, so net of 50, gross of about 250. Cash neutral, we're going to come on to this one, this is quite interesting. 100 long, 100 short, so gross 200. But the only thing we've said in this portfolio is let's provide the best portfolio that is cash neutral, and let's not worry about any other factor exposures. And you can actually see here, these ex-ante risk exposures are, they sort of pretty large, and we're going to look into this a little bit later. They have quite a big impact on the end result. And then finally, we have a factor neutral. So we've said, okay, with the same alpha of the same signal, create another portfolio, which is same net, same gross, so 100, 100, but let's give us the best expression which neutralizes all my factor exposures too, meaning that when ex post we put it through something like a Barrow analysis, which the consultants will use, our specific risk number comes out very high, which is what makes it investable, right? That's what the LP is paying you for, specific risk. So the portfolios, you can see, right, they're all roughly the same number of stocks, and the strategies, the net and grosses are what they should do. But what we're going to see is that, first up, the ex-ante risk exposures were very different, those big blocks of data, and in a couple of them it was very clear. And ex-post, the risk attributions look very different. And the experience of the LP, of course, is very, very different. So what's the experience of the LP who asked for your signal invested in the best possible way in a 130-30? Well, clearly, you don't get much specific risk. So this block here, the top block, risk attribution, is what pops out of, this happens to be our risk model rather than a Barrow one, but risk model's a risk model. You don't get much specific risk. You have a lot of market exposure. So 130-30, you're 100 long, of course. And there's a wee bit residual factor in macro, although within error, that really isn't a big number. How do you do? Well, the gray line is actually the S&P, and clearly this set of alpha selections has got value because you outperform the S&P. I mean, you're long, your net is long 100, and you outperform, but you have similar size drawdowns to the S&P. If you're long bias, so you're in this case, what are we at? 150 long, 100 short. You have more specific risk. You'd expect that, and less market risk. And you get, again, there's good alpha in the selections. And actually, this one works out pretty nicely. You don't suffer as big a drawdown as the S&P.
And one thing to notice here, though, even though we're only 50% net exposure, our specific risk is still only 26%. Almost 70% of the risk attribution is coming from that market risk. So when we think about that long bias product, yes, we're delivering much lower drawdown than the S&P, but we still retain that big slug of market risk.
Market risk, yeah. Cash neutral is quite interesting. The yellow line, it looks fantastic, and we're going to look into why it looks so fantastic a little bit later. Again, even though you're cash neutral, you still have a lot of residual risks that aren't market risk. So your market risk is negligible, almost zero, and you can say I'm market neutral. But actually you have very big exposures to factors and macro factors and style factors. And we're going to come into that. This is quite an interesting point. But of course, the portfolio does very well, and we'll look into why that does. The factor neutral, so again, the same set of stocks as inputs generate a completely different portfolio with very, very high specific risk. And this portfolio is actually, of course, what the endowment guys want. They want to be paying you for specific risk, not for things they can buy through an ETF. And you can buy growth factor or style factor ETFs and pay almost nothing. If I'm paying you 2 and 20, I want to pay it for your specific risk. And what I really want, I want to see two things that's important. I want to see a high specific risk number in the ex-post risk attribution. I want to see low in the ex-ante, the grid we showed earlier. And when I look at my results, I want to see my drawdown being very low. Because actually that's what high specific risk means. It means that extraneous things which, I don't know, dollar yen moving or the interest rates moving don't impact your portfolio. And for that to happen, this specific risk has to be very high. The market and the factor and macro risk have to be very low.
And bad drawdown would mean that bad ideas, really. Bad alpha.
Yeah. Well, a bad drawdown, if the portfolio was constructed within risk tolerance, would be a a gradual drawdown, which means actually there was no alpha, or your alpha had no value. But if you've constructed it properly to keep specific risk very high and other risks very low, your bad drawdown would be a gradual bad drawdown, where you get something wrong. And you can see here, even in the February, March, where the S&P smashes down, the high specific risk, low market risk portfolio just, moves a little bit, which is exactly what you want it to be doing. So this is a much more comfortable portfolio for an investor who perhaps isn't as interested in exactly how you're generating your signal, but wants to know that he or she is paying for how that happens, rather than paying for exposure to bonds or whatever. Now, so when we look at this is the ex post risk attribution of the four portfolios. And again, you'll get this out of Barra. Your consultants will get it out of Barra. You can get it from Sherpa. There are probably 1,000 ways of doing this. Where exactly which way you do will, move these numbers by a couple of percent. The point of these types of analysis, though, is not precision, right? These sort of analyses are very not precise, but they are sort of broadly accurate, right? So whether this number is 75 or 85 actually doesn't matter. What matters is it's quite a big number. Whether this number is 5% or 15% or 0 doesn't really matter. What matters is a very small number. And any, I kind of feel a bit silly even publishing it up on the screen with the decimal place, because it has no real meaning at that level of precision, but it does show a real picture of what's going on. And the interesting thing, again, comparing the factor and macro exposures between the two neutralized portfolios, the ones that don't have market risk, and we'll see what impact that has. So the first question, before we go into sort of the analysis of the return, so I got something in my eye here, is what have you sold your investors? What have you told them you're going to do? Now, clearly, these are quite big gradations, right? There's a very big difference between a long bias and a cash neutral, and that's a very obvious gradation. But within the conversations and the offering memorandum, there are lots of subtleties about what the investor expects and what you are setting yourself up to deliver. Right? That's the big thing. Really understanding what the investor expects. We're all in the business of sales in one way or another, and we can sort of say something that we think the investor is wanting to hear, but ultimately, if we're delivering X and the investor is expecting Y, we're going to have a bad relationship. If we're delivering X and the investor is expecting sort of X, but a little bit different X, a French X rather than an American X, you might be able to get away with that, but you still have to be conscious that that's what's happening. But the point is that any of these result sets are fine if that's what you've said to your investor you're going to get, right? Even though the 130/30's got a big drawdown, if that's what you said your investor's getting, listen, we're retaining full market exposure, but we think we've got better upside, then that's what we've achieved. The 130/30, the green one, we've retained market exposure with full upside and full downside. If we've done the 150/50, the long bias, well, actually we're saying, listen, we've retained upside exposure. We've actually outperformed upside exposure, even though we're only 50% long, and we've done all right on the downside as well. That's what we expected. The fully neutralized, the dark blue line here, we've given you what you wanted: very low drawdown, no extraneous factor risks. The one that stands out, of course, is the cash neutral. Look at it go. I mean, a sharp of 2.25. Again, properly calculated, low drawdowns. That's absolutely flown. what's going on here? And this is quite an interesting thing, because you can say, okay, at the very beginning of time, I decided to give you a market neutral, or the investor wanted a market neutral portfolio. I've got a signal, and whether it comes in our case from this AI machine or from a bank of analysts or from any other research firm, I've got a signal. I've generated this thing. This is pretty cool. But really, what's going on? How come I outperformed the factor neutral so much? What's really happening?
Even outperformed the long bias in this case.
Yeah, although the long bias is, of course, crippled by the March smash down, right? So, but what's going on? Well, if I look at this, if I look at the attribution in a little bit more detail for the cash neutral portfolio, we can see, the net factor attribution. So we've got 50% specific, no market to speak of, but we're 20% and 25%. So about the same amount of risk as the specific is in factor and macro. And the factor in particular, you look at it, well, we're long growth, we're short value, and in the macro space, we're basically heavily long bonds, we're short rates. So we make money when rates come down. And that's the ex post attribution. If we look at our ex-ante risk factors, we can see that throughout the period, I don't know why that's gone 2020, sorry, but throughout the period, we have been ex-ante short value. We've been with a bit of volatility, but reasonably consistently long growth. And we've been long beta to the bond in a ex-ante view. And then ex-post view, we've got those same attributions. And if we look at how did those factors behave over the time period, well, that's the price of the 10-year bond. That's growth, which sort of poodled around, but over the last 4 or 5 months has done pretty well. And the value has, of course, massively underperformed. So that's the return of those pure factors. And I'll call the bond a factor as well, because factor is just a risk attribute. We could, again, long conversation about that, but factor is just a risk attribute. So even though our specific risk is 50%, the 50% which is macro and factor has clearly worked very well for us in our favor. And that leads us to a question. Maybe I'll go back here. What are we actually doing in this portfolio? Is our alpha signal an alpha signal that implicitly contains those factors, and therefore we should never neutralize them? Or is our alpha signal just happen to get us along those factors? And particularly with something like an AI signal, it's very hard to query that signal to understand what it is. Although you can look at the consistency of these numbers historically and go, well, it looks to me clearly that this particular signal is consistently delivering a short value, long growth, long bond style portfolio. Does it know something? I don't know. We don't know about that, but it's a really important conversation to have. It's like, well, given that I've got this signal coming in and I've got these options of creating market neutral or factor neutral portfolios, what one should I create? How do I decide what the right thing to do is? Now, there's no, this is obviously the right answer to this. The answer can only come with how you talk to your LPs and what have you said to them that you are doing or delivering. How will you cope with this? And that's quite a sophisticated level conversation. And in many cases, you may not be able to have that conversation, and only after the fact you might have to explain it. But it's a very important thing that if your signal has a factor bias, should you neutralize that factor or not? Have you been paid to neutralize the factor? Have you been paid to take the factor? How do you explain that with your clients?
You'll have to explain it eventually.
Yes, I mean, undoubtedly, you're going to have to explain eventually. So keeping these three views of your life, which it's interesting because you're a long short manager and you spend a lot of time talking about your stock selections and what it is that drives your alpha. But then when you look at your absolute returns, do you have a picture like this, or do you have a picture in which these things are neutralized? And it's a very important thing to have in your mind, particularly when talking to investors, but also when constructing your portfolio. So very briefly, just I know we're at 30 minutes. We've decided we've got our alpha and we've chosen what sort of risk we're going to create, which type of these four portfolios. The next level is how much of the risk we want to take. And just to illustrate, this is the factor neutralized portfolios, again, pass through the Sherpa portfolio construction process, which does a lot of stuff. What is the outcome with different levels of risk? How much risk you want to take? Again, these are all 100 long, 100 short. So same net, same gross, same alpha, same factor neutralization, different risk appetites. And you can see you can get very different answers. Then the third part, and we have talked about this, I think, in webinar 2 or 3,
a few,
2 or 3,
more than
probably
one.
2 and 3. The third part is once you've got your signal and you've got the right type of risk and you've got the right amount of risk, then you have to say, okay, what's the right portfolio construction? What is the right way of expressing my view, compliant with my risk, compliant with what I've sold with my product, so that I get, of all the possible outcomes, which is represented by these green lines on here, I get something like the light blue line, 60th to 70th percentile of possible outcomes. And again, we talked about this a couple of webinars ago. Very normal to see, and we have reams of data on this. PMs who do a good job mentally without clever tools like Sherpa, typically end up around about the 50th percentile of possible outcomes. And putting a process in place elevates you from the 50th to the, let's call it 65th or 70th. Right? So that's the sort of the big picture, right? We've talked about taking alpha, choosing a type of return set to deliver to an investor who wants that type of return set, choosing how much risk to take in that thing, and then constructing a portfolio that gets you the best possible expression of that risk within your constraints. And I think that's where we are. Yes. So
that's great. We actually have a pair of really good questions here. And so I'm going to tackle the second one first, and then Richard, maybe I'll kick the first one over to you.
Okay.
So again, thanks everybody for taking the time to go through it. We're going to take as much time to go through questions. So if there are a lot of questions, great, we'll talk about them. If not, that's okay too. So the second question here from Douglas is, practically speaking, if you're a believer, if you're an equity fund manager, don't you want to have some of your cash in the equity markets? And that's absolutely a valid view, right? And that's, I think, the point of tracing back to this idea that if we think about the different strategies and if we think about kind of where the different buckets are, if you want, to be a very high, if you want to maximize specific risk while still having some exposure, some beta to the market, that's an overlay you can put on. That's a factor overlay you can put on if you want to be essentially cash neutral, but with a certain amount of beta. Or if you say, look, I want to be net 25% long, so kind of a low amount of market exposure, but you want to have some amount of market exposure. There's a fund that we've been working with, a LATAM hedge fund, where their goal, what they've sold their investors on, is 100% exposure on the upside with specific selection risk, while trying to only capture 25% of the drawdown in that same market. And so they're absolutely, they're equity investors. They believe in those markets. They think that they can outperform those markets enough through selection to, retain the upside with significantly limited downside. And so that's the point of this whole discussion really, is to say that that's a conscious choice that, number one, you need to make sure you're doing what's aligned with what you're selling, with what your investors want, because that's what's going to help you retain and grow assets. But number two, it's going to be a conscious choice. Once, if you tell your investors, look, we're believers in equity, we're great stock pickers, and so we want to be, on average, call it 25% in the market. You have maybe a band around that, and so you can be as low as 0 or as high as 40. You can choose that, but it's a matter of making sure that your portfolio is delivering what you've told your investors and what your investors want. And then once you're in the right box for your investors, that's where you come in to really fine tune how much of that risk you want to take. So the right amount of risk. Does that make sense, hopefully?
Yeah, I think that's exactly what happens. I think you have to be conscious. There are, for instance, investors for whom, if I go back to this chart here, where's the cash, this one? There are investors who will say, I am giving you, fund manager, money at 2 and 20, of course. Yes, please, dreamland, but at whatever you can get out of them that's not quite 2 and 20 today, provided that when I run your portfolio through my ex-post risk attribution calculator, that this number here, the light blue number, is above 75% at all times. And for that to be the case, you can't have market risk.
Right.
Because as soon as you have market risk, the market risk number is going to be huge. And that's a particularly, if you are a long short manager managing money from large institutional investors who have 80% of their money allocated at 15 bips management fee to long only benchmarks, and who definitely don't want to be paying 2 and 20 for beta.
I think in my experience, sometimes you see this as a difference, coming from an American background, with regional allocations where someone's a regional specialist and people don't really want to get involved because they think, I'm really not comfortable with the amount of, like mining names, for instance, or I'm not comfortable with the degree of utility, like whatever it is, So they say, look, in this region, I want a specialist. And so I'm comfortable taking a certain amount of that market risk. And I want, and that's another set of elements that we haven't talked about today, but in terms of setting up what risk you want, if the investor comes to you and they say, well, look, we want the market risk and we want your selection alpha, but we don't want this industry. We don't want this sector. We don't want this type of name. So there's a number of different ways, I think. But again, all of those are, let's say, equally valid to different investors based on your conversation with your investor and what they want.
Yeah, exactly.
So the other question here, and
the other question.
This one's a slightly more, let's say, calculation, quantitative in nature. So we'll shoot it Richard's way. So when we're thinking about individual single stocks, right? And I think this is something that for, again, like we said, most stock pickers are spending 90% of their time, right? And this is the old studies, polls, whatever. 90% of most stock pickers' time is spent picking stocks. It's spent talking about stocks. It's spent on single company stuff, not necessarily on the portfolio compositional elements. And so, they kind of think about specific risk frequently in terms of the idiosyncratic risk factors of a company. So when we think about specific risk in terms of can you really think about how specific risk is modified by individual single name positions?
This is a thing which happens. What would we mean by specific risk at a portfolio level rather than at a stock level? At a portfolio level of long short stocks, it's the quantum of risk that is not attributable to other things. And practically in a business sense, other things means things that you can buy for free through an ETF. I mean, in today's allocation world, specific risk means exposure that I cannot get through an ETF, and I'm willing to pay you 2.20 for whatever the number is you can get. Right? I'm sorry, I'm far too old.
1.5 and 15.
Yeah, right. But the point is, I can't go out and get an ETF at 4 bips to give me it.
Right.
And so, this guy here, this cash neutral thing, given the historic, so the thing's done really well, but given the historic attributions to it, an allocator can look at that and go, okay, great, but half of your returns coming from factor risk, and you are long bonds, long growth, short value. I can buy bonds. It costs me again, I'll show my age. It costs me 30 seconds. These days, I think they're decimalized, right? I can buy bonds. I can buy the growth ETF. That'll cost me 4 bips. And I can short the value ETF. That'll cost me about 8 bips. Why am I paying you 2.20 for that? Because that's your consistent factor thing. So am I not better to pay 2.20 for this return? So 20% of 7 rather than 2.20 of this return, because I can get roughly half of this from my factor and macro exposure bets, and I'll get the other half, which is here from this guy, and that's what's going on. And I mean, quite reasonably, it's what's going on in the allocators, certainly the big professional allocators' minds, right? Because what are they really trying to do? They're trying to maximize their return they give to their investors, which is net of fees. Right? That's the whole point. So going back to your question, when we look at, it adds a specific factor, it takes away a specific factor, we don't really think about it at a single stock level. We think, what is the overall portfolio? So if we want a portfolio to be neutral on factors, for every Amazon, which has a growth factor exposure, say, then we need something that has a value factor exposure or a negative growth factor exposure, or short another growth factor stock.
And I think, so the short answer there is, when we're thinking about that specific risk, that specific risk is very much a portfolio level characteristic after we've sort of balanced out and hedged out all of the other, residual factor risks, macro risks, you name it. And like Richard said earlier, from a risk model perspective, you're going to see somewhat different variations on how that gets computed. And so that's why, practically this conversation might come up if you're not proactively having it and guiding the conversation. It might come up when your investor, their consultant, has given them a report that they've run from whatever their preferred risk model is that gives you, a growth of X, specific risk of X. And so if you're not guiding the conversation, there's definitely something there where you could end up with numbers that they should be same ballpark, but might be fundamentally different. And no, absolutely, to that add-on point there, if you're good at tilts, timing is very much something that investors try to pay for. I mean, because being good at tilts, not necessarily having a persistent tilt. So if we looked at that set of factor exposure there was the most consistent tilt there is that short value tilt. That's every period ballpark stable and has added a lot to the returns. and they could buy that in an ETF easily.
Yeah.
If you're saying that growth or that bond element where, the directionality changes occasionally, the magnitude changes a little bit more significantly, maybe those are risks where you're saying that there's something involved in, your ability to time factors or to put on tilts, to take conscious factor bets. And again, if your investor wants you to take factor bets, there are absolutely people paying for, managers who are good at taking factor bets, good at timing factors. And so,
yeah, and if you set your stall out, if you set your stall out to be, I am a great timer of factors,
yep.
So expect me to have factor risks, and that's what you're paying me for, then that's a stall. But as you said, Douglas, in the comments, yeah, if your tilt is static, you're going to struggle to get someone to pay you 2 and 20 for it, because there's no value add in that.
Yep.
So Sam is asking about emotional risk. Some stocks are more susceptible to an emotional narrative than others. And so I'm going to generalize that question. We have on this picture, we've created an attribution risk model with these factors, right? So value, quality, growth, momentum, risk, short rates, long rates, and dollar yen as a proxy for whatever dollar yen's a proxy for. In order to do that, that's the ex post attribution, because we know how those things go. But ex ante, if we want to constrain exposure to some other factor, and Sam's factor is like the susceptibility to emotional trading, or basically let's call it the Robin Hood factor, right? What's the US day traders doing tomorrow factor. And if Sam, you say, okay, here's my portfolio of stocks, and here is my list of weightings or attributes to that particular scores to that particular attribute. So these stocks are very sensitive to the day trader, and these stocks are not. And therefore, I want a long-short portfolio which is neutral to that, which would mean as much weight as I've got in the ones that are highly sensitive long, I've got to have short effectively. So you can create, if you have your load, we call it loading, that's a bit technical, but if you have the attribute loading for any attribute of the stock, I mean, you said emotional risk, but how about, I want to be neutral on, the average age of the board, or what type of car the directors drive.
ESG.
Well, or ESG, right? As long as ESG is a great example, because the difficulty with ESG is getting a recognizably stable and valid loading for each company. You can buy an ESG rating for people. You could create your own. You can do the same with your emotional risk. You're susceptible. I mean, you could basically say, okay, Robin Hood, what are the main stocks that you trade? We kind of know what they are. Okay, so let's make sure that we are neutral to the Robin Hood stocks, and therefore remove your. I think emotional bias is a great way of describing it. But it, like Stephen says, it could be ESG, could be a number of women on the board, it could be age of directors. I mean, age of directors is an interesting attribute for Japanese stocks, for instance. It actually has alpha, that score. So anything.
Well, and to spin this question another way also, when you think about kind of the real narrative heavy emotional risk stocks, right? So think about a Tesla, for example. So Tesla's obviously been a huge winner on high emotional risk, let's say. And so huge run-ups, bone-crushing drawdowns. There's also a degree to which the second step, the one that we've talked about before that we haven't really gone through today, where if we're thinking about high emotional risk stocks, high narrative risk stocks, the actual nuts and bolts of how you construct the portfolio, those are going to have recognizably different downside volatility profiles in terms of how those get put together in the portfolio. And so there's both thinking about it from a constraint factor loading, how you can generalize saying, I want a control for this type of name. But there's also, a degree to which mathematically you can look at those names that have this greater degree of volatility, this greater degree of narrative and emotional swing in the market. And, if that tends to really be the case, those are the names that you can see that quantitatively by filtering through it in terms of, different vol metrics, drawdown metrics, etc.
Very good.
So I appreciate all the questions today. Always glad to go through things. If anyone wants to talk about this topic more, if you want to run a set of data, run through a portfolio or a set of alphas that you have, by all means, Richard, myself, our colleague Craig, who is on the call as well, helping moderate, contact information is here. We're always open to both, talk portfolio construction topics, kind of talk about the ideas, talk shop, or to run data and to show you how it works. We've built portfolios of a wide different variety for different investors with different risk tolerances, risk mandates, and it's about helping you as a PM understand what risk you want to take, and then use better portfolio construction techniques to deliver that risk. So I'd like to thank everybody for taking the time today. We've gone over time with questions, but again, we're always happy to do that. If you came in late, or if you had to duck out in the middle, something happened in the market, as usual, this will be on the Sherpa Funds Tech Process Alpha YouTube page. If not later today, certainly by tomorrow morning, as well as our previous webinars covering some of the actual nuts and bolts of the candidate portfolios and how we actually approach construction once this risk you want question is settled. So by all means, check out the replay if you missed part of today's session. Reach out to the team below if you have any questions or if you want to look at a set of your own data. Otherwise, Richard, thanks so much for taking the time today to go through all this with us.
Yeah, thank you, Stephen. Again, fantastically well organized. Thank you very much to the attendees and the question askers as well. Very good. Thanks very much, guys.
Great. And we will be sending out information about the next Sherpa webinar as we get it prepared. So look out for that, and we will see everyone next time. Thank you.
Thanks, guys.